Thanks for tuning in to Around the Coin. Today's interview is with Michael Safai, the managing partner at Dexterity Capital. In this conversation, we talked about high-frequency trading, which is what Dexterity does. We talked about the influence of TradFi and crypto. We talked about the international affairs and macroeconomics and the growing tension between the US dollar and Bitcoin and all the implications that has. We discussed regulation, maybe some ideas around creating new regulation, and what the world looks like in the future. Michael is in a really unique position to be operating in 2023 in high frequency trading. So we talked a bit about high frequency trading, what the reasons that high frequency trading firms do well, what struggles there are, influence on AI, and many other ideas. I hope you enjoy this conversation. Please do give us a share, thumbs up. And without further ado, here is Michael. All right, Michael, thanks for hopping on. I'm excited to dive into some topics today with you. Maybe we can kick it off by talking about Dexterity Capital. I think talking about high frequency trading, low latency, high frequency trading, and where that relevancy is in trading today, as crypto is obviously less active than it was in 2022. I'm curious, just to set the table here, like how many firms are active today relative to maybe a year or even 2 years ago? And how do you sort of think about the market?
Yeah, it's changed a lot in the past 2 years. And there's this great, fantastic bull run in 2021. Just so many opportunities, so many things to trade. It was a lot of fun. And during that time, there were a few old school guys like us who've been doing this for years that are crypto native. We know how things work in the crypto world. During 2021, we saw kind of two major types of entrants. Number one is traditional HFT shops that do stuff in TradFi. So your towers, your jumps, your citadels, those guys were all there. And even Jump and Tower specifically were kind of earlier to the game because they thought it was an exciting space. And then your second type that cropped up in that window were kind of guys who were newish to the game and just saw an opportunity because the market was so frothy. It's kind of like, it's hard sometimes to say it wasn't free money at that stage of the market. There were so many pricing efficiencies, so many venues, so many exciting new products. There were all kinds of ways to succeed as a high frequency trader or even like a medium frequency trader in crypto. So that was kind of the heyday, was 2021. But, 2022, market cools, Terra blows up. And we see a lot of those kind of new guys back away because unlike us, they haven't seen bear market after bear market, cycle after cycle. They didn't know what to do. So that's kind of one category. The other category during that period, the TradFi guys who had came in, they were still there and they were still kicking even after the Terra thing, doing a lot of volume, presumably making a lot of profits. That all changed with FTX. When FTX collapsed, people got really scared. That was a massive counterparty. People trusted it. They thought they were too big to fail. They thought they had an American founder who was going to be accountable and reliable, not some kind of something flung off offshore where you just don't have any recourse if something goes wrong. When this happened, a lot of these traditional finance shops got freaked out and they backed away from the table. Not to say they're gone. They're still out there today, but they're not at scale. So I've spoken to, of course, lots of exchanges, and one offshore exchange I spoke to, speaking about one particular HFT shop that was TradFi, and he said, yeah, before FTX, they happily plunked out $100 million on our exchange and trust our custody. These days, those guys are down to 10. They've really pulled back. And then we had the Binance problem. And that was even scarier because, CFTC didn't quite name names, but they didn't make it hard to figure out who trading firms A, B, and C were necessarily. So after that, we've seen even more pullback, specifically from Binance, but also some other places. So it's a much smaller kind of cast of characters in the HFT world in crypto today.
And when you think about the differences between maybe folks like yourself who had been in crypto and thinking about things from a crypto first principles perspective and trading compared to people who came in during the 2001 rush on the TradFi side, was there a difference in maybe the principles in which they operate or the technical infrastructure in which your side of things built up? Like what would be the difference between people who sat down in front of a desk and they pull up, like, I imagine they're thinking, pull up a Bloomberg terminal and analyze graphs? I mean, is there a difference in how you actually do high frequency trading, or is it basically the same thing? When TradFi guys came in, they take the same playbook they've been doing with corn and commodities and whatever else, and then just apply it to crypto? Or is like, how does that work?
It's kind of a split. We might talk about it in terms of trades and strategies and infrastructure. And trades and strategies are what's your game plan? What are you going to buy and sell very fast every day? And when I talked to people who came from TradFi, there were kind of two observations. One, they assumed they were going to kick everybody's ass because they had all the good infrastructure and they knew all the plays and they were going to deploy the same plays in crypto. And the second thing that I would hear from them that was interesting was that, wait, this still works? This old trade that hasn't worked in FX for a decade is still open. It's still on the table. Wow, this is easy. Let's go do it. So the strategy guys and the traders, super excited, saw lots of opportunity, saw things that hadn't worked in years in TradFi were suddenly available to them again. So they were happy. But then you've got the infrastructure guys and traders say, hey, come and build an integration with Binance for me or FTX or Coinbase, whoever. They're like, cool. I've built so many integrations with TradFi before. I know exactly how to plug into exchanges. They typically use something called a fixed connection, which is a standardized protocol that you use to feed your trades in and to listen to the exchange and action things. So one of those infrastructure guys, when I sat down with the trader and said, cool, point me to the documentation for the fixed integration, I'll build it in a day. And the trader says, yeah, there's no fixed connection, actually. They don't do that in crypto. This is all kind of new. Some people do have a fixed connection, but it wasn't standard the way it was in TradFi. They're like, okay, fine. I guess API and WebSocket, is that how it goes? Give me the documentation for that. And the answer was, yeah, sure. Here's the documentation. Some of it's in Korean, some of it's in Chinese, some of it's very old and hasn't been updated. Go build on that. And by the way, everything is going to change every few days or every few weeks. Exchange is going to push out new changes to how they integrate with their traders. And they may tell you that that's going to happen and they may not. They may retire the old documentation or they might not document it at all. So these guys who were building infrastructure who thought they were just going to have a walk in the park were shocked because this is not nearly as organized and simple or standardized as it is in the traditional world. So that was kind of shock number one to the infrastructure guys. Integrating with exchanges is really hard in crypto because it's a new cutting edge space that changes everything all the time. I think the second thing that was really difficult for them was around how, when you're getting data back, how do you consume that data? They're used to consuming data in a standardized way. They get from the exchanges. Well, that's different. And I think the third big thing for them was all this infrastructure that they built for decades. Like they have custom built FPGAs. They have dug holes through mountains to create a direct line of sight for the microwave tower network they've spent millions and millions building for TradFi. Doesn't matter. Doesn't work in crypto. That big edge you thought you had, it really isn't there. Crypto exchanges tend to be hosted in AWS, just like every kind of tech company, Amazon, whoever. They're used to plugging into a co-location facility where the exchange has a physical machine and they put their box as close as they physically can by paying a big fee to get next to them and then optimizing how short their cable is so the latency is minimized. All that expertise, pretty much worthless in crypto, doesn't help you. So long story short, I thought it was going to be easy. They're going to come kick ass. They've been doing this for such a long time. Totally different rules of the game. And that was a shock.
Yeah. On that third point there, the infrastructure, in 2021, when, everything is growing and there's a lot of inefficiency in the market, does the tightness of the code, the efficiency of the code, the frequency of the trades, does that matter as much if there's so much inefficiency, or is high frequency trading more relevant when the market is tighter and more efficient and I guess less? It makes sense to me that it'd be when the market's more volatile, high frequency trading is more relevant. But like, what are the conditions for which high frequency trading would be most relevant?
Yeah, I think here's the thing that's the other big split between TradFi and crypto. If you're an HFT shop in TradFi, you think of things in nanoseconds or microseconds, so 10 to the -6, 10 to the -9, very small numbers. It turns out that in kind of crypto world, since you're all gated by this AWS infrastructure or Alibaba Cloud or some other cloud provider, the best you can do is going to be in the order of milliseconds. So 1,000x slower than they're used to. Wow. So yeah, you can go optimize your code. You can go get really low level. But when you do that, all you're saving is microseconds or mics, as we colloquially call them, right? Well, that doesn't matter because you're on the millisecond scale now. So even if you improve 20 mics, which is a big deal in TradFi, does not matter in crypto. You've got this speed bump. It's called cloud infrastructure, and it's going to limit you to that millisecond area. So I think that's kind of the big change that they had to go through in terms of maybe more directly to your question.
What are the conditions for maximum relevancy for high frequency trading? Like when are you sitting back being like, now's a great time to be a high frequency trader in crypto?
So traders traded like us trade on volatility and volume. So moments when there's a lot of trading happening is definitely a big plus. And we like that. And we thrive then. When things are quiet, not so great, you still make money. The way we think about it is I'm going to do X volume, and on my volume, I'm going to make 5 VIPs or 5/100ths of 1%. So a really small number on that volume. So I take 5 VIPs and multiply it by X volume. That's how much money I make that day. So of course, if volume goes down, you make less money. That sucks, but you still make money, which is great. If you're a shop like ours, especially that's market neutral, we don't care if prices go up or down. We feed on volatility. So high volume times are the best, but there's a caveat, because when all these exchanges are new and they're all cutting edge, when there's a lot of activity, things go wrong. If you have an exchange where you can usually send orders within 20 milliseconds, for example, during a quiet time, it might spike to like 300 milliseconds. Like FTX was actually particularly bad at this. During periods of stress, your round trip latency would go up 10, 15x. And that changes things. And you have to be ready to catch those lagging data feeds.
Interesting. How many, if you had to guess, how many people are doing this full time? How many people are sitting in your position as a full-time crypto high frequency trader?
Not a lot. I mean, I'm going to say probably the people who are really good at it on the order of thousands in the planet.
Oh, okay.
It's a really hard thing. It's really specialized. And you've got to kind of, it's information that's not publicly available. You can't go Google, how do I high frequency trade and get a good guide? You won't. It's all knowledge you have to get by blood, sweat, and tears. So the people who can do it have to be incredibly smart. I'm, just for the record, I personally am not a trader. I'm the dumbest guy on the team. Proud of that, actually. But generally, my guys that I've met, they should be curing cancer. That's what they should be doing. They're way smarter than your average bear. So there's just very few people who qualify for this intellectually. And then you have to get into that kind of knowledge of how do you actually execute. You can have the raw horsepower of intelligence and money and hardware, but you have to figure out a way to crack whatever this super clandestine secret crypto system is and compete with the best in the world. So really, single thousands is my guess of how many people work on this full time.
And when you think about, it's kind of a good transition. When you think about the upstream benefits to society that high frequency traders provide, or maybe even just crypto traders more broadly, do you think of it as providing efficient prices across different sources, maybe exchanges or basically all the different exchanges out there, so that when someone comes into the ecosystem, it makes sense? Bitcoin's not 20,000 over here and 24,000 over here. There's like tight bandwidths, and that efficiency in pricing across different locations makes the whole system more stable. Is that how you would describe it, or would you describe it differently?
No, I think that's mostly right. I'm not going to tell you we're saving the world. We're not. We're making money off of very minute price differences across exchanges. But if you're a retail trader, the presence of people like us who do unify prices, who make sure, for their own benefit, of course, that the price of Bitcoin, for example, is the same on Coinbase, Binance, Kraken, everywhere else, that's actually a good thing, because as a retail trader, you're on equal footing with whatever platform you can trade on in the world. And crypto is global. And it would not be very cool if, hey, I'm trading in Germany and I should get a very different price than someone trading in America. Part of what we do helps tie prices together. For the most part, there are some places where there are premiums, like you might have heard, like Korean premiums. Sometimes even when you convert won to dollar, you'll have a higher price for Bitcoin on Korean exchanges, or Nigeria is another good example. And there's a few reasons this happens. Sometimes it's because in the case of Korea, there's currency controls. They're very strict about who can trade in Korea. And you look at Nigeria, you've got kind of a hyperinflation situation there. And so you have to be very careful with who you let trade in Nigeria. So there's some reasons prices diverge. But in the places where there aren't currency controls or the government's not really meddling with the specifics of that, it's generally a good thing for retail that we're all on the same stage.
How about, let's talk about exchanges more broadly. I think this is just a super relevant time for the way that governments and exchanges relate to each other. There seems to be just an obviously growing tension, at least in the US, between the relatively few exchanges out there, which I would love to see dozens. I would love to see dozens of thriving exchanges, or at least different ways that you could exchange USD to BTC and get into the crypto ecosystem. But I mean, how many are there, right? There's like Coinbase, Kraken, FTX, rest in peace, Binance. Like, count on two hands. I mean, one hand, two hands. Like, and is that a target by governments? How overtly do you think the United States and other leading Western countries view Bitcoin and cryptocurrency as a target, as something they're maybe behind closed doors that they're really trying to pressure out of existence? How do you think about that tension?
Well, it's kind of funny. Initially, we thought of this a few years back. There's all these exchanges. Consolidation must happen one day, right? If you look at the NYSE or NASDAQ, there's kind of only so many big exchanges out there in the world. And that's what we thought was going to happen. We thought exchanges would buy each other up. Didn't really happen that way. Acquisitions are actually kind of far and few between for exchanges. Sometimes they'll buy something because it's in some region that's underserved. They don't have the customers there. So they'll go buy an exchange in Thailand or something. But for the most part, they don't really consolidate. So that was our expectation. What caught us a little off guard is that what really happened was failures in regulation is causing consolidation. And that's for two reasons. One, people are now really careful counterparty risk. They're not going to go deploy $1 million, which is a small number for a lot of traders of kind of scale, to a little exchange somewhere in the world because they may never see that $1 million again. So that was kind of the big change. The second thing, as you mentioned, is regulation. And I don't have any personal insight into what's happening with the CFTC and SEC. I wish I had an inside line. I wish they'd call me first, but they don't. But what you can kind of put the pieces together, the US feels threatened by crypto. And the USD, the dollar, is kind of the world's currency to a certain degree. And it's very important for the American government to have hands on that. They want to grab, be in control of where dollars are. And when they saw what was happening with stable coins and exchanges popping up everywhere, they really kind of didn't like that. That goes against the narrative of controlling your currency. When we saw FTX fail, that was almost a golden opportunity for people within the government who wanted to stop this from happening, because suddenly it was a clear threat to retail investors. Americans lost money on FTX. So when they saw this, it became an easier pitch to sell. And my belief is at this point, US would be a lot happier if crypto just went away.
Yeah. And you can't forget Celsius, because my understanding is FTX affected international. There was two different accounts, two different almost like company operating manuals, where the US version of FTX, I think, is solvent, although it's locked. I don't know if people have actually received any money, but the Celsius was a American operating company, very large, not an exchange. They were more what would you call that? Like class of
a lender,
right?
Yield for people to lend to them, and they would lend out to people like us.
Right. Exactly. Like centralized crypto lenders, which in hindsight 2020, it's something to be very skeptical of. Do you feel that government regulation is obviously a positive thing? I mean, just devil's advocate here, you could have an ecosystem that develops where a few exchanges break the rules, they do things, they screw over customers, everyone learns from their mistakes, and then a slew of companies come in to effectively provide free market assessments or ratings of different crypto projects. In fact, I know that's what you guys originally were trying to do, is provide different ratings for crypto projects out there. Is that not a ideal pathway to have the market provide a rating system and an auditing system for exchanges instead of the government? I mean, how do you look at that pros and cons of government versus free market?
Yeah, I think, what we call them in traditional finance is like SRO, self-regulatory organization, like FINRA, technically not a government entity. It's actually something that's run by the industry to make sure there's all fair play. And the benefit to the industry is that if they regulate themselves and they do it well, the government's not going to come in and change things. Crypto was harder because it was kind of a scattered set of players who were making decisions. They were competing with each other. They didn't know what jurisdiction they were going to be in anyways. They kind of hopped around jurisdictions, like Binance has moved a number of times, I think. So for them, getting all together and creating a self-regulatory organization just never happened. People tried, but it didn't work. So I think in an ideal world, that's what should be happening. And I think, look, I want regulation, and I think a lot of exchanges want regulation. Coinbase went and talked to the SEC and the CFTC many, many times over the years, tried to work with them. DYDX, same deal. They were very close to kind of the CFTC and what they were building to make sure that they don't kind of aggravate them. Unfortunately, they never got clear guidelines. They never got a clear story on how to operate things from the government. So they kind of had to guess, and they were guessing on frameworks that are very old. Simple question of what's a security? You go back to the Howey test, which is a court ruling in the US, and try to apply that. Doesn't really work great for something that's decentralized. One of the core things that decides with security is whether it's managed centrally. So does decentralization adequately get rid of that and therefore say you're not security under the Howey test? They couldn't get an answer from the regulators. And I think part of that is it's a really hard problem. Crypto's weird. It's new. You've got a bunch of kind of stodgy old folks who are running these organizations. They're not going to understand it. They're not going to really care about it. It's tiny compared to what's on their radar. And then second, back to my earlier point, it was a threat to the US dollar hegemony. That's really important to America politically. I think that's really what happened here. People wanted regulation. We didn't get it. And now the SEC and CFTC are kind of taking heads.
Yeah. But where does this go? Right? Like, do you see this pointing towards like greater than 50% chance there's just a straight up, like, I don't want to use the word war because it kind of connotates like shooting missiles and that sort of thing. But this is more, I don't think there'll be any missiles flying, but there'll be a lot of lawyers involved, a lot of threats, maybe even like a physical threats, like the government has guns, like cryptocurrency exchanges don't. So therefore, like you either get out of the country or like we're just going to come knock on your door and shut you down. I mean, do you see any way, or should the community of people in crypto be doing anything now? For instance, I saw Texas and Florida, Wyoming has some DAO laws, but Texas and Florida were pretty recently explicit in how they're going to respect people's rights for Bitcoin. And I would imagine that that's going to lean towards more conservative red states. But like, I don't know, leaders in crypto be trying to advocate for any sort of preparation today before, I don't want to say before it's too late, but I don't know how else to say that.
No, I think they've been advocating for clarity on how to operate and they're just not getting it. So what's going to happen? Nobody knows. But the way we're heading right now is that, look, crypto's not going away. You can't get rid of it. Enough people love it for whatever reason they do. And there's lots of reasons to love it. What will likely happen is that it'll be two systems. You'll have everywhere else offshore. So you'll have what's happening in Asia and Europe be under kind of a different umbrella. And then what's happening in the States. And the States seems to be kind of checking out of crypto. They just don't want it to be part of the financial ecosystem. So if I had to bet right now, I'm usually wrong. That's where I think we're going. Crypto is going to be a non-US enterprise for the most part, but I hope I'm right.
Yeah. Well, okay. So I think you could quite simply observe the incentives. Like United States has a massive incentive to keep the United States as a global reserve currency. The number I heard was 86% of US dollars in circulation are held by people outside the United States. And so when the government prints money, gives it to their own citizens, it's basically a tax on the rest of the world, but it benefits the US asymmetrically. So US has an incentive to keep it there. If people just have a free exit, doors open to Bitcoin, then that presents a threat. And so it would make perfect sense. This is kind of Balaji Srinivasan's whole pitch, is that people are going to be flooding for the exits faster and faster. So get out now. And he has a famous $1 million bet on this. Yeah. I certainly can see all the large chess pieces aligning in that direction. It just seems like such a uncertain, settled state, right? Like, are small countries like Palau and the British Virgin Islands, Bahamas, are these places just going to be exploding with innovation? People are moving there, they're creating large exchanges, and then the future of the internet and decentralized cryptocurrency is all happening there. The obvious consideration is that, like, I think about the psychedelic ban on psychedelic medicines back in the 70s. The United States basically said, no, we're not allowing this. And then they use their influence across the world to pressure other smaller countries to take on the same regulation. And therefore, it was pretty much stopped worldwide, at least in the West. And so the obvious question is, what is the range or the influence that the US has in pushing their anti-crypto policies to smaller countries? Like, could they effectively stifle any innovation by pressuring financial regulations on other smaller countries? That to me seems like where the real tension is, because everything prior to that point, I don't see how else it could go. It seems to be the pattern. Ray Dalio is famous for proclaiming the rise and fall of civilizations. They seem to have this series of properties that happen after they start printing money and go into high debt to GDP ratios later in their life cycles. It's like the United States is like, oh, there's where we are on the cycle. And you can sort of see things happening as they have been observed in other civilizations. But to me, it's like is that going to happen? Are people going to literally move? Like, would you move to say England came out and said, hey, we're just going to ban cryptocurrency? Would you move? Would you guys move the company to a smaller country? And maybe, do you see other people in your friend circle, like being willing to leave countries to continue their work? Because that seems
I won't speak about. Yeah, I think you're right that there's a threat of like a brain drain or what's kind of the cutting edge of fintech, right? So it's a crypto brain drain. And I won't speak for myself or Dexterity because there's lots of reasons to move. Business is one, but I like my pubs. I like my house. I'm probably not
I know. That's soon, the thing. Right? We all do.
But what you've posited had already happened. They famously moved to Hong Kong.
Yeah.
I know countless Americans who left the States and went to Hong Kong, Singapore, Panama was a hotspot for a while, Zug in Switzerland. They went to places where jurisdictions were friendlier to what they were trying to achieve. So that's already been happening. And I think anyone who's going to want to do crypto has to consider that. If you're a founder and you really, the focus of your life is that business, it might be a really good decision to get out of the States at this stage. I love the States. It's a beautiful country. It's just, there's no place like it on earth. But at the end of the day, you want to build a business, you have to make that tough choice. So we've seen it happen. I think it'll continue to happen. I think your earlier point that the US has a lot of kind of clout throughout the world and can enforce regulations internationally is definitely true. And that's not necessarily going to change anytime soon. Many of my friends out here in Europe complain that they have nothing to do with the States. Maybe they've never been there. They go to open a normal checking account at their local bank in Austria or wherever they are. They always get asked, are you an American citizen? And Austria is not asking that for their benefit. They're asking it for the American benefit, who has their kind of fingers in every banking system around the world. So they'll definitely try to use that leverage. But look at the world today. It's not a coincidence that this crypto squeeze is happening now. We're seeing this kind of axis develop between Russia and China and parts of the Middle East. And this kind of global, it's not a full-on Cold War, but it's getting there. It's happening. And a big piece of that is what happens with finance. So will that clout matter if China formally becomes an enemy? I don't actually know, because what leverage do they have anymore? And that's what we're going to have to wait and see, depending on how the macro situation evolves.
Hard pivot to AI. Do you see AI presenting I don't want to label it as good or bad, but a maybe more efficient or less efficient influence on trading? Like when you're sitting there, I presume that you guys have a lot of code running in the back end. You're probably designing that code with some concepts in mind, some goals in mind. Is AI, from your vantage point, something that's going to drastically improve the efficiency of, call it like back office trading, high frequency or otherwise, some way? All algorithmic trading, I imagine, probably is going to be highly influenced by AI. Is it already today? Like, where do you see that influence happening?
I think definitely in those back office functions and a lot of the more mundane things, this is a massive boon to have AI to cut out a lot of the things that you have to do the hard way, just using human minds. But there's a problem here. There's a lot of, I won't name any names, but there's a lot of different places out there where if you're just an average retail trader, you give them your API key for, say, Binance, and they say, we'll run automated trades for you. And that sounds great if you're just a retail guy who knows nothing about HFT. Problem is, you're using it, so are another 10,000 people. They're all using effectively the same bot. And then they're coming against guys like us, who our job is to identify what those bots are doing and try to beat them. And we do that through a lot of effort. So my question to you is, yes, AI could change a lot of how people trade, but if everyone's relying on ChatGPT-4 or whatever, right? They're all relying on the same AI tech. They're just going to be like equally matched. It won't change anything. And the difference is we call AI 99% of the work. That last 1% that's human is going to decide the winners. And it already does to a certain degree. I have lots of smart people working for me. All the other crypto native shops do. Certainly the big TradFi shops do. And we're all butting heads trying to get as much as we can against really smart opponents. So look, we spent years building our infrastructure. We spent years developing strategies, but they constantly need updating and human kind of intervention to make them better and to get ready for what the opposition is doing.
Yeah, it almost feels to me like you have a line of 100 athletes on a racetrack going around in an oval, and all of a sudden the racetrack just went from dirt to rubber. Everyone is much faster, but the difference between who comes in first and second and third might be a matter of inches. And so the last 1% really is where all the gains or losses are made. And AI is just like the infrastructural boost to everybody.
I think that's 100% right. I watch F1 and you can see two drivers like Red Bull fundamentally in the same car, but the difference between Max Verstappen and Checo is they're two different people. And that's what decides the winner.
Yeah. Super interesting. How do you feel about AI more broadly in either crypto or even more broadly in the world? Do you see it as something that's going to be a short-term massive influence to economic production? Do you think the perception on that is overinflated? Maybe the actual tactical integration of AI into people's daily lives is not as quick and seamless as people make it out to. Certainly the ability to write blog articles, prepare legal docs, like those things seem to just be happening, but whether or not it actually connects and integrates into complex worlds that have multiple inputs across different software systems, I'm less convinced. I don't know. What's your take on it?
Well, I think I used to be a lawyer, and man, I wish we had ChatGPT-4 when I was a lawyer, because I spent a lot of time writing stuff that I probably could have done in an hour with this. At the end of the day, I still have to go argue with the judge. And I know whether the judge had a bad morning or not. I know what the judge, like if he went fishing and he's happy or not, or his wife left him yesterday and he's pissed off. And often that despite the case, believe it or not. So even if I had AI in my legal work, it's not the whole solution. The good lawyers will still distinguish themselves from the poor ones. So that last human bit, I don't think it's going to be automated soon enough to really matter right now, but it definitely changes the game. And look, this isn't the first time we've experienced this as a civilization. If you think of a good example in medicine is a radiologist who looks at x-rays and MRIs all day long. And back in probably the 70s, this was an incredibly lucrative business to be in if you want to be a doctor. Now, however, it's fundamentally changed because it takes them 2 seconds to send that to somebody in India who has lower cost of living, but is also a good doctor. And they can outsource the reviews of the x-rays and the MRIs and then send back the results. And then a doctor in America does the final step of delivering the results or interpreting them and discussing them with the patient. And that was a big shift in that business. And we've seen it in tech too, with engineers worldwide working on a project that's, for example, in the US. That's happened. This is kind of the next step where we eliminate certain steps. And it's not so much outsourcing it to people, but outsourcing it to machinery. So we'll see what that ends up. But I can't imagine a world in the near term where AI isn't a big piece of it.
Interesting. How sophisticated are people right now, say traders, on their trading techniques? Like, I'm trying to get a sense for, are they taking into account data from APIs from some satellite company out there and then crunching where trucks are moving and trying to figure out, like, are they at that level where they're incorporating all sorts of data sets like that in all sorts of unrelated and uncorrelated sources? Or do you feel it's more primitive than that people are really trying to just analyze graphs of Bitcoin versus Ethereum versus all the other cryptocurrencies, and they're purely looking at it within the confines of crypto? So give me a sense for the sophistication of human beings behind the scenes in trading today.
So if we talk about what you described as, like, let's call it third-party data. When I get data from Binance, for example, I listen to all what's happening on exchange. Look, you can call that second or first party, depending on how you think of it. There's all these other data sets, like you said, what the weather is, where the trucks are, what are people tweeting. If you look at traditional finance, people have been consuming that and researching that for years and years and years. It's bread and butter for many hedge funds. Everyone knows that game. Crypto is definitely lagging in that department just because it's still new. and there's so much low hanging fruit. The markets remain so inefficient. There's so many venues that you can make profits without spending $100,000 a month for some third party data source. So people are primarily in that stage of the market. And as it evolves, people will move towards integrating those additional signals that are derived from third party data. But even still, I've known crypto native funds that for years, their whole play is we scrape Twitter. We do it faster than anybody else. We know how to interpret emojis really well because emojis are far more discreet than words. And based on the emoji and the pair in the tweet, whatever coin it is, I don't know, like Flare or Solana or whatever, they can make decisions about where they think the price is going. So it's being done, but it's not nearly as sophisticated as in Trap.
So would you agree that the difference between the 98 and 99 percentile performers on trading might be not the ability to assess the data on Twitter and scrape it, but the actual ability to gather that data, whether it's from an API from satellites or scraping off some website somewhere or Twitter? Like, is it really just going to be about a race to collect data and then everyone's using the same tools, like AI tools, to analyze that data?
I think that's feasible, but I think trading shops are a little funny. They're not like Walmart where they sell everything. They don't run every kind of strategy, right? Often shops zero in on a strategy they're really good at, and then they might spend the next decade improving it and fighting off people who try to steal their lunch. So that's a big part of, especially the smaller shops, a lot of the crypto shops like ours. We have our bread and butter, and that's what we focus on. And I don't care how much third-party data you give me, it might not help that. So it's hard to say when you think about who's better or who's doing a better job of getting stuff. It's hard to say if that's really what the key is. I think it'll be more important as we go along. When someone hears, yeah, there's a signal in the data about how much ice cream was sold that day and how it correlates to Bitcoin. Well, that's interesting. Everyone's going to grab that and it's going to become part of the baseline of how you trade. That last little bit comes down to what your bread and butter is and what you know that nobody else knows.
And is it about, are secrets valuable in trading? Like if you were to just tell me now, hey, here's exactly our bread and butter. Here's kind of how we think about it. Here's what we know. Here's what we don't know. Here's what we're experimenting with. Here's our approach. If you were to spell all that out, is that commonplace in trading? Is that like, oh no, I would never do that because that's our valuable IP? Or is it more like the execution of it is the valuable thing? Yeah, Mike, here's how we do everything. No big deal.
Well, my execution has secrets too. So secrets are kind of the crux of trading at the end of the day. It's what you know that nobody else knows. A really simple example. One time we were trading on an exchange and we found this API that wasn't documented and we plugged into it and we're like, wow, this is 10 milliseconds faster than what everybody else is using. Let's keep using that. And our P&L went kind of through the roof. And then it was quite funny because maybe a month or two later, something broke. That like API didn't give us the right data. We called the exchange, said, hey, this endpoint broke. Can you tell us what's going on? They're like, is it broken? We don't know. I'm like, well, haven't other people told you about it? They're like, no one else has told us it broke. And that's when we knew it was a secret.
That's a good example, actually. That's a really good example.
Yeah.
Interesting.
Yeah. So that made bottom line difference to us. So secrets are like at the core of trading shops. And you've seen trading shops are very aggressive with their NDAs and confidentiality agreements and enforcing them. That's really the key. And there's definitely other trading shops who want to steal those secrets and will interview your people and try to get them to spill something, or may even hire them and try to get them to bring code with them. So that certainly happens.
Wow. That's super interesting.
So it's like kind of, it's CIA-ish, if you know what I mean.
Yeah.
And we're very careful about what we allow people to know within the company, because not because we don't trust them, but you never know when something might go outdoors.
That's fascinating. And so it's right. Integrating with the API is 1% of the work. Actually finding the API and realizing this is a valuable insight is where the vast majority of the value is. Not to say that actually building it and integrating the data isn't hard or isn't itself something that everyone could do. And how would you pick?
Yeah, I think 99% of winning the lottery is buying a ticket. But at the end of the day, that last 1% decides whether you've got $100 million or not.
Totally.
Same with trading. You have to spend all that money to get in there and all that research and expertise. But that last little bit, that decides whether you win or not.
And how would you describe, are there different themes to these? I don't want to call them secrets, but they're like strategies. Like you mentioned Twitter. Is there like do you think of this as, okay, if you were to paint the map of different trading firms out there, Do you have like the social guys, the guys trying to get indicators off of what people are talking about socially in the internet? And then you have is there some kind of high level macro map that you can draw?
So secretive and clandestine, it's hard to point to who's doing what. And it's often hard to kind of discern it. And when I talk to other traders, we don't say much to each other about the trading. It's not because it's still a secret, but something we might say might trigger something in the listener's mind that says, oh, there's a connection there. We should go investigate that and go find out what the secrets are. So I think that's what it comes down to, is every little secret can kind of be what decides your fate and fortune.
Wow. So why do podcasts? Why go out here? You guys aren't raising money. I would love to talk a little bit about prop trading, not taking money from investors. But before we do that, what do you operate the business? Like, what's the strategy of the business? Why do podcasts? Why have an externally facing brand? Where do you guys want to go?
Yeah, I think, why we actually talk to people, which most prop shops don't do, is because I think part of the maturation of this market space there needs to be some knowledge to it. If everything's behind closed doors, regulators don't know what to do. People don't know what to do. People don't know what's important. And counterparties think they can get away with anything because nobody's talking, right? And that's not what I want this industry to be. TradFi is not exactly my jam, but there's a lot of things they've done right. And part of it is having a higher degree of transparency in the institutions in TradFi than we have in crypto. That's really important. So I think that's really what motivates us to go talk to people and tell them at least a little bit about what's happening. I don't really tell you anything too secret, but we want people to know that this stuff is happening so it can be addressed, so it can be intelligently assessed by people who are going to regulate it or be accountable for it.
And if you could wave a magic wand and have any political or societal change as it relates to policies, regulation, is there something that you're striving for or would like to see in the world?
I think the most important thing is clarity. As I said earlier, a lot of regulators aren't equipped to understand what's happening in crypto. They try to regulate it and they say, well, this isn't going to work because of X, Y, Z. So they just don't even bother. Or they do regulate it and it's so heavy handed because they don't understand the nuance. And part of that's because nobody's talking. So what I really want is governments, regulators to come out and say, you can do this, you can't do that. And for them to do it intelligently and with the consultation of people who understand this space.
Have you ever seen, I've always thought this because I've heard that explanation on when I've interviewed other founders of their crypto projects. And I've often thought, why not just do it? So what if you and 4 or 5 other smart traders out there got together and say, let's just write a Google Doc. Like if we're leading the SEC or whatever, this is what we think it should be. And just have comments as to why you have this specific policy. Like, okay, if we want greater controls, we would do this. If we want less, we would do this. And kind of almost from a legal approach, like write the doc, write comments to show why you made a specific wording of a specific policy the way you did, and just open source it, like open letter to the SEC, please consider this. Because I imagine they're sitting there, none of them have experience in crypto. None of them, they're maybe even listening to this podcast or other podcasts, trying to parse out what's actually happening. Maybe they're opening up their own account, trying to figure it out. I mean, they might be complete newbies. And I often hear smart people like yourself saying, oh, we want great policy. If you were to just like make it easy for them to buy, make it easy for them to say yes, like here's the doc, open source, don't even give me credit, just take it, put your own name on it, call it your own bill. Like, have you seen that done? Why not do it? Is that a stupid idea? Like, what are your thoughts on that?
I think that people have tried to do it. Like if you look at the Blockchain Association in DC, definitely they're on the Hill. They're working with people all day long, trying to kind of help people understand what's happening here, why it's important to the world, and what the nuances are so it doesn't get regulated in a kind of negative way. I wish I could do it. Unfortunately, it's time is what it comes down to. At the end of the day, am I going to go spend my hours doing that or trying to boost P&L? And it's a tough decision.
Yeah.
Because it's really what I'd like to see. And this is part of the problem. The incentives are all wrong here. And then again, earlier, as I said, people like Coinbase, DoIDX, they have tried to do this. And we've seen where they're kind of hitting a wall. So if regulators like want to talk, come talk, but they just haven't been receptive to that yet.
So hypothetically, put 2 hours a week. I feel, I mean, not to push you in any direction, but given your background as a lawyer,
put me on the spot, man. I love it.
I feel like you have such a unique credibility in that you were a lawyer and you're running a high frequency trading firm and you're successful at it and you've been doing it for a while. and you have other smart people. Like you're not sketchy, like not individually, but you're not sketchy from a like a outsider's viewpoint. And so if you were to get together and say, okay, we got 10 other leaders in respectable firms, we use AI, I don't know, use something to draft it up, and you guys go through, spend a couple hours editing it, get out like an MVP to the world just to do the thing. It doesn't have to be perfect, but at least you have comments. You go through, is it worth 5% of your time to do that, and then push it forward? And also maybe it gets ignored. Maybe no one else picks it up on Twitter or anywhere else, but maybe there's a 5% chance it does. And maybe it inspires other people in other sectors, like the exchanges or the like foundations, what other areas are pushing for regulation. Because I just hear this message a lot, but I think it's obviously not worth 50% of your time, but maybe it's worth 5% of your time to get out an MVP, just to offer the olive branch, like be the first one to extend some sign of work, because it is work. And I don't think you would be happy, like in any legal negotiation, like I want to buy your company, whoever presents the first draft of the document kind of has the advantage, and that the other team is going to be redlining the original doc presented by the bigger team. So that's how I sort of think of it. Is like present the draft, let them draft it up, edit as they want, but at least you have the framework out there in the world. I don't know.
I think that's actually, I've never thought about that. So that's actually not a bad idea. And it might be something worth exploring, I think. And I'll say that, like, for me, it's a bit easy because I'm out there in public. I talk to people about what we're doing. A lot of people don't want to be seen. They want to keep their secret secret. They don't want to become a target. They don't want to run into trouble. So I think that's part of what's disincentivizing other people from getting out there. But I think it's certainly something I should spend some time exploring, because it's actually not a bad idea. I'm skeptical it would move the needle given the current climate. But as you said, if it's only 5% of the time, it might be worth a shot. And if it's a lot of crypto is taking asymmetric bets, and maybe it's another asymmetric bet that will pay off.
Yeah. One thing I've certainly noticed is that I see a strong change in the attention of politicians, right? You've seen this too, but just pointing it out, is there's less value and trust placed on powerful, centralized publications, and more emphasis placed on podcasts and individual producers on Twitter, primarily Twitter. I mean, maybe you could argue YouTube as well, but it's like, really, it's like, okay, if you hypothetically you put this thing out there, it's whatever, 10 pages of Google Doc powered by AI for the, like, you could get it out there, I'm sure, pretty efficiently. And then you have a few other people who are willing to put their name on it, given that they just at the bottom said this was reviewed and stamps with approval from these people. So all of a sudden you have kind of a snowball effect of credentials, and then you just throw it out there, like tweet at all the people, maybe it gets picked up. Maybe you do a couple podcasts specifically trying to talk about this. Number one, it gives you something to talk about, which podcasters love. Like if you came in with a mission, like, I want to talk about this piece of policy that our team wrote in coordination with other high frequency traders. And then it's like, I think people are dying for meaning and a mission, like someone to come out and say, this is what we're trying to accomplish in the world. We're trying to bridge the gap between policymakers and crypto, because everyone is aware of this tension. Everyone does not want a war between BTC and USD, but yet that's where we seem to be. So the more bridges happen, the less chance there's just collateral damage everywhere.
That's interesting. And it's I think another component of it's a really hard problem, admittedly. I used to admit that I wasn't a great lawyer. That's why I do something else. And I'll be the first to admit it. So if you sat me down with a bunch of SEC regulations that wade through them and make them make sense in crypto, it would be hard. I would definitely need the lawyers' helps with that. But I think it's something that could potentially work. And I think you're right. The right avenue now has changed. It's not about centralized mass media kind of getting the message out to people. I just wouldn't put it on TikTok. Not to be crazy about that.
Yeah, TikTok probably doesn't seem like the right platform now. Yeah, no, I think Twitter is probably your better bet. Cool. Well, I fully support that. If I can connect you with other people who I've talked to, I'm happy to do that. We've covered a lot in this conversation. We talked about high frequency trading. We talked about the international influence of China, Russia, the macroeconomics there. Is there any area that we didn't touch on that you think is important, worth giving some time to?
I think one thing we started as we're called Dexterity Capital, And part of that reason is when we started trading in 2017, we traded on DEXs, and these things were broken. They were just in really bad shape because they were new. You would see things where someone was offering to buy a coin for a better price than the lowest ask. So a crossing order book. I mean, that's actually how we started. We could see that like someone was bidding 10 cents for this thing and another person on the book was offering to sell it for 9 cents. Well, we just took both orders and made a penny, right? And that was great. We did that all day long. So DEXs, decentralized exchanges, dexterity, that's kind of how we came about. And we ended up focusing on centralized finance and high frequency because when 2018 came along, DeFi cooled. And then that's where the money was. That's where the opportunity was and activity was. One potential outcome and the next problem for regulators to tackle is how do you tackle DeFi? And that's going to be interesting. It has this double-edged sword of real transparency. Things are on chain. You can see what's happening. Nothing's really that anonymous. Everything can kind of be traced back to some people. We've seen with many of the recent hacks that often they give back the money because they really can't dodge it. It's just going to happen, right? But it does kind of ask fundamental, interesting questions. If you think of a DAO, a decentralized autonomous organization, how do you regulate a DAO? How do you sue a DAO? They are operated by thousands of people who each have a vote and distributed across the world. And this is a problem that, I love the problem because it's really hard and interesting. I have no idea how to address it. I'm really curious how the world's going to see that when centralized exchanges are kind of getting hammered. Crypto is going to have to look at DeFi more aggressively.
How does it work today? I don't know if you know the answer to this, but the first thing that comes to mind as an analogy to DEX ownership would be real estate ownership. You could have a 5-story retail building owned by 150 people, none of which have more than 1% ownership. Is there a parallel there? Like, is there a board of directors or some sort of governing body? Most crypto projects have a foundation that's maybe 3 to 5 people who manage the funds for a project, like the Ethereum Foundation, Solana, et cetera. Do you think that sort of ownership structure or governing body structure makes sense?
It's hard because these things are all direct democracies. Ultimately, every decision needs to be voted on by all the token holders. Otherwise, you have central management. So you're talking about a condo or buildings or what's frequently called a real world asset, RWA. RWAs are cool, but at the end of the day, someone's got to maintain that building. Well, you can hire vendors, but then you have to have a direct democratic vote where every token holder votes on that. How frequently are they going to vote on this, right? Are they going to spend their time worrying about this? How are you going to get your plurality or your quorum or whatever you need to get things done? So you end up, again, with RWAs, you end up with centralized management being pretty much necessary to make sure that building plumbing gets sorted and people are paying their rent or their HOAs or whatever. And that's still very tricky. So we're still in that infancy, and I don't know what the right answer is. And unfortunately, we also don't know from regulation perspective what the right answer is. And that's going to drive exactly how it operates. So it's really kind of an open space in terms of what will happen. Very hard to take a bet.
Yeah, the challenge with direct democracies, whether governing bodies or in digital land, is that it puts all the computational responsibility for every decision at the edge of the network. Everyone has to do the full load to contribute a vote that's valuable. And in lieu of that, you can all vote for people who do the work. And so therefore you can be part of 10 different DAOs or DEXs. And your job is to vote for the smart people. And then those people spend all day, all night thinking about the best policies for that DEX. That kind of I think that was the innovation of the US Constitution. One of the major ones was like direct democracy is just incredibly taxing, no pun intended, on every person that's a part of it. If it's going to work,
Right.
That's the trade-off. Yeah.
Yeah, I think. Yeah, what we run into again, and this is US centric, but is again that Howey test. Because if you're holding that token, I'm sure you've nominated some guy to go make the smart decisions. That sounds like centralized management. And that means your token is likely a security. And because we are still working with this dated regulatory framework of what a security is, it makes life hard. So I think you're right. Like representative makes a lot more sense for this application. But without clarity on how a representative DAO will be treated, it's a tough bet to make.
Yeah. Yeah, we need new laws, effectively.
Oh yeah.
Well, back to the last point. This was super fun. I love the name Dexterity Capital. It sounds like you guys are working on some really exciting stuff. And thanks so much for hopping on. This is a really awesome and dynamic, inspiring conversation. Are you writing publicly, personally, on Twitter or blogging elsewhere that you want to throw out there?
Not really. I wish I was, but it's just so hard to make time. And there's so many smarter people than you can write better stuff. But I should spend more time on it for sure.
Cool. Well, we'll have all the links for the company in the show notes. And thanks again. We'd love to have you back on someday.
Anytime. Thanks so much.
All right, brother. Talk soon.